Good afternoon. I want to thank everybody for logging in for our educational webinar today on being the bank with a self-directed IRA. During the next 45 minutes or so, we're going to discuss a little of the rules and ins and outs of self-directed IRAs, but focusing primarily on individuals who use their IRA funds to act as a private lender and some of the issues that are associated with doing lending from your IRA, or as we title the seminar or this webinar today, being the bank with your IRA, where someone is coming to you or some party is coming to you to actually borrow money, and what is entailed in having your IRA act as a bank for other individuals. Now, as we go through the live presentation today, if you have any questions for me, please type your question into the chat box, and I'll make sure I get to your question at some point during the webinar. If you're watching the recorded version of the webinar today, please just write down your questions as you go along, and just call me or email me at the end of have the information at the end of the presentation. Be happy to talk with you and answer the questions you have regarding the contents and the education provided in today's seminar. My name is Scott Maurer. I'm the Director of Business Development for Advanta IRA. I've been with the company for a number of years now, doing some of the transactional work initially, helping people invest and reinvest their funds into various types of self-directed assets. I've spent more of the last few years doing the education and networking and marketing for the company, and helping inform more people about what it is to have a self-directed IRA, what the rules are, how the process works in general. Now, a quick disclaimer on Advanta IRA is that we don't provide any investment advice, and we don't give any legal or tax advice. Now, we will talk about some legal and tax issues today, potentially in the seminar, and some things to consider. But if you have specific questions on how something might relate to you as an individual, whether or not it's a good or bad idea from a legal or tax perspective, we would refer you to an attorney or a CPA who is familiar with self-directed IRAs and hopefully can answer your questions on that. Now, again, explicitly, we do not provide any investment advice, so the decisions an individual makes on investing with a self-directed IRA, where to put their funds, who to invest with, what type of investment to make, that it does all fall to the individual. We are not going to give anyone guidance in that regard in saying you should or should not make a particular investment. Now, a quick background on our company. We've been around since 2004, and the only thing that we do is administer self-directed IRA accounts. So we only take in qualified money, either IRA, Roth IRA, maybe an old employer-sponsored plan like a 401k, 403b, and we do the record keeping for those assets. Again, we do not sell any investments, so we're not looking to put your money into any stocks and mutual funds. We're not going to try to sell you a piece of real estate or try to sell you a private loan, but just merely provide the service for individuals who want to invest in an alternative asset, doing the record keeping, doing all the administration that comes along with those types of accounts. And the reason why we exist is a lot of people haven't heard of self-directed IRAs because they're banks and brokerage firms that hold a majority of the retirement plans in this country typically do not allow for the alternative investing within their structure of the accounts that they service. So you might have an account with a brokerage firm or a bank that you can invest in mutual funds, you can invest in CDs, you can invest in stocks, but they're not going to permit you to invest in real estate or in private loans, as we'll talk about today. Those custodians are permitted to limit what they will hold, just as we can do so as well. IRS regulations might allow for a very, very, very broad range of investments to be held within an IRA account, but each custodian can decide what it is that they're willing to handle. And again, we've made the decision as an administrator to kind of handle the alternatives, the unique, the different things that people want to make invest in within their IRA accounts. Now, with the types of assets that can be held in an self-directed IRA, really any type of real estate, whether it be raw land, whether it's commercial property, whether it's a short-term rehab or flip, whether it's a rental property, it's a kind of buy and hold strategy, and just buy the property and accrue the rental proceeds back in your IRA, whether that is a residential property, whether that is a commercial property, condos, duplexes. If it has a deed, your IRA can certainly invest in that particular asset. We also hold a number of paper assets, and this is primarily what we will be focused on today when talking about private lending, but the ability not to buy actual dirt and actual real estate or maybe a hard asset, but rather invest in a note, invest in a mortgage that might be secured by a piece of real estate, but the asset held within the IRA itself is a note. It is a loan Could be a mortgage loan secured by real estate. It could be an unsecured note that actually has no collateral associated with it. We'll go over some of the risks of doing that type of loan in a little bit. We also see a number of kind of debenture notes, option contracts, assignments, tax liens, kind of a lot of other different things where, again, the asset is not being purchased, is not actual real estate or actually something that's physical in nature, but really just a note or a promise given on a piece of paper. We also hold a number of kind of other alternatives as well. Individuals investing their IRA into private LLCs and private partnerships. The LLCs or partnerships might hold real estate. It might be a hedge fund. It could be a startup company. Those types of investments are very diverse. What's held within those particular LLCs is held within those particular partnerships. As you can see, we hold a number of you can hold a number of different investments as well inside a self-directed IRA, whether it's a foreign currency trading account, whether it's commodities, oil and gas. Even have some clients who own some precious metals as well. So again, the universe is quite open as to what you can invest in. The IRS only really restricts you in just a few different scenarios that we certainly will cover here in just a little bit today. Now, as far as the types of accounts that can be self-directed, any type of IRA, whether it's a traditional or Roth, kind of an individual retirement account, whether you have a plan through your employer, a SEP or a simple IRA account, that can certainly be held, can be self-directed. You just have to have a SEP or a simple setup, through your employer, and then you can in turn invest those funds. We also offer individual 401k plans. If you own your own business, you would like to set up a 401k just for yourself, you don't have any employees, you can certainly do that as well. It's kind of the same rules as a 401k, but it's much more simplified because you don't have employees, just you have to provide for. We also offer education and health savings accounts. The main differences with a lot of these accounts really are either the amount you can contribute in a given year and some of the distribution, the tax rules, especially as it relates to maybe a Roth IRA as to the others. But as far as the types of accounts, any type of IRA account, also any type of an employer plan that you were for somebody who you are no longer working for, whether you work for the county, you work for the federal government, you work for a private employer, and you have then a 401k or a 403b or 457 plans, all those former employer plans can also be self-directed. The only restrictions on employer plans exist when you are currently or you are still working for that employer. If I'm still working for a company that is offering me a 401k, or I'm working for the government and getting a 403b plan, I may not be able to move that money as long as I am currently employed. That is a kind of a plan-by-plan basis. But again, any old employer's plan, and certainly any type of IRA, can be self-directed into the types of assets and the investments that we'll talk about today. Now, going over being the bank, we're going to talk about the types of private loans that individuals have made. We're going to spend a little bit of time, especially though, on disqualified persons and prohibited investments. There are certain things the IRS says you cannot do within your IRA account. There's certain investments you cannot make. You also have to be careful who is on the other side of a transaction. So we'll talk about that a little bit. Then we'll go through a number of case studies as well. They're going to illustrate some of the advantages of private lending, some of the disadvantages, or some of the things that you need to think about at least before engaging in this type of an investment. We'll finish today's webinar with an example for actually having an IRA borrow funds to make a real estate purchase. Now, primarily what we're focusing on in the majority of the seminar today is an IRA itself being the bank lending money for a third party. The last example will show an IRA actually being a borrower to acquire a piece of real estate. It's kind of an unusual scenario, something we don't see a lot of, but we thought we would cover that today. Now, the types of private loans within an IRA, again, are just as the investment options within an IRA are very diverse, the types of loans that you can make within an IRA are very diverse as well. As you can see on this slide, there's a number of different ways that people lend money to one another or people borrow money from some other party. Could be a traditional mortgage loan, and even within a traditional mortgage loan where somebody's lent you money to buy a house, there's a variety of different terms involved. You have a 15-year fix, a 30-year fixed mortgage. You could have an adjustable rate mortgage. Again, kind of the examples and the possibilities go on and on. You could see short-term loans, people doing very quick 2-3 month bridge loan type situations. You could have unsecured notes whereby there is no collateral. So it's obviously a riskier note someone just lending money based on a promise to pay on a piece of paper. We've seen clients structure their loans in an equity participation or a joint venturing arrangement, whereby the individual who is lending is not looking for just an interest rate back and a return on their investment, but maybe a portion of profits as well. And we see a number of secured notes as well on different types of assets. Now, most of the secured lending that we see at Advanta and with our self-directed IRA accounts we hold is in the form of a mortgage, where the security is a piece of or a parcel of real estate. But it is possible to use other types of assets as well to secure an interest in a note. We'll discuss that in a little bit more detail and some of the things you need to be more careful of when doing that in just a little bit. Now, in the universe of IRA investments, the IRS, when IRAs were created back in 1975, decided to simply limit individuals to certain types of investments that they could not make, and also certain people that their IRAs could not transact with. So rather than trying to figure out the myriad of different mutual funds, stocks, real estate investments, private loans, etc., the IRS simply placed limiting rules on the IRA investments as opposed to what would be prohibited or what would be permitted. So the only two types of investments that the IRS has prohibited within an IRA account are either life insurance or investing into collectibles. And collectibles would include your antiques, artwork, collectible stamps and coins, things where the value is maybe not as readily apparent. Maybe there isn't a fair market value for those types of assets. So we don't get a lot of questions day to day on individuals wanting to invest in life insurance and collectibles, although we'll have a caveat to the collectibles because we're going to talk about that in just a moment in the context of a secured note. So you can't invest in life insurance and you can't invest in collectibles with your IRA account. The IRS also restricts who your IRA can transact with on the other side. There's certain persons, certain people or entities that the IRS labels as disqualified persons. So your IRA is not permitted to transact with any of these individuals regardless of the terms, regardless of whether or not it's a fair market transaction or not. It's an express prohibition for your IRA to transact with you as the IRA owner, your spouse, your parents and grandparents, your kids and grandkids, as well as any spouse of a child or grandchild. And they also include any business or entity that is owned or controlled by one of the above. So in short, when you're looking at lending money from your IRA account, you cannot lend money from your IRA to one of the individuals who would show up on one of these boxes. So you're not permitted to lend money to a son. You cannot lend money to a daughter-in-law. You cannot lend money to your son's business. You can't lend money to yourself. Now, one thing to mention, get a question quite often about borrowing from your IRA account. People thinking, I can borrow from my IRA, and that's simply not the case. What people have confused is if you do have a 401k plan, for instance, through your employer, a lot of times 401k plans do allow you to borrow a certain amount of money from the plan, and then you pay it back over a 5-year period of time. That is something that is unique to those employer plans that does not carry over and does not translate into investing with an IRA account. So you cannot borrow from your own IRA account. So again, the IRS prohibits you from transacting with these certain disqualified persons. So the prohibited transaction then involves your IRA, a disqualified person, and then again a transaction going on between those two individuals. So if, again, in the context of what we're going to talk about today, if your IRA is a lender and a disqualified person is a borrower, it is simply not going to be allowed. And again, regardless of the circumstance, regardless of the terms, it is an express prohibition. So if your IRA is a borrower, another individual is a lender, that also is going to be prohibited. If the disqualified person is a lender, again, transactions going on between the two are always prohibited. Now, just some other things to think about. Again, brothers and sisters, this is something kind of unique, but brothers and sisters, aunts, uncles, cousins are not technically disqualified persons under the rules. And kind of, if I went back a couple slides, you remember only as directly up and down your lineal tree, brothers and sisters being out to the side, they are not disqualified. However, we do caution you, if you are going to lend money or deal with a brother or sister, and really possibly anyone for that matter, when you're lending money, when you're doing a transaction, it really should be on a fair market basis. If you're dealing with people on a less than fair market basis, you're lending money on lesser terms, for instance, and that person would have to pay a third party or pay some other party, the IRS may question what else is going on in that transaction. Are you personally now benefiting in any other way, which could lead to prohibited transactions? So again, in your dealings with family members who are not disqualified, and maybe even others, friends and associates as well, make sure you're dealing with them on a fair market basis. Also, using a middleman between your IRA and a disqualified person is called a step transaction and is also prohibited. If you have money in your IRA account that you would like to lend money to your son, and you decide instead to lend it to a friend who's not disqualified and have your friend turn around and lend it to your son, the IRS will consider that a step transaction and will also consider that to be a prohibited investment. If they were to track each step of that process, they're going to disallow that transaction as well. So putting somebody between your IRA, or even putting maybe a few people between your IRA and a disqualified person, is not going to work. Another situation, A's IRA lends to B, and B's IRA turns around and lends to A. I think this could definitely be a facts and circumstances type test, but bear with me as I go through an example what I think would be prohibited and maybe an example that would not be under this scenario. So if you have two individuals, A and B, both of whom are not related, so they're not disqualified persons off the bat, but each of them has about $20,000 in their IRA, and both of them would like to borrow money from their own IRA account, but of course they realize that's not possible. You're not allowed to borrow from your own IRA. So A and B talk and decide, well, how about we just lend each other the money? So I'll lend A will lend B $20,000 from his IRA, B will lend A $20,000 from her IRA on equal terms. I think that's a situation where the IRS could say this is more of a step transaction. You've kind of done some maneuvering with the accounts to enable you basically to take money out of your IRA account, or at least have use of funds within your IRA. You used your loan from your IRA to in turn obtain a loan from somebody else back to you personally. I can see that being a prohibited transaction scenario. At least I'm not positive the IRS would say that, but I think that's certainly a concern you'd want to think about. Contrast that with you have A and B who are both investors, and A lends money to B so that B can use cash to go acquire a new investment, and they arrange terms between the two of them of what that loan might look like, and A's IRA makes the loan, and B then pays back the loan, maybe satisfies the loan at some point down the line, and then B looks to lend money from their IRA to A. A found their own investment, separate investment, maybe it's a different amount obviously that's needed, and they establish a loan under separate terms. I can see that being more of a scenario where each different transaction was separated from the other one, and that being more of an acceptable type of investment as opposed to a situation where two people work together to lend each other the same amount of money on identical terms. Last thing to think about, and we'll talk about this again a little bit later, what about having your IRA lend money to a non-disqualified person, but having the security for that note be a prohibited investment, basically being a collectible? And this is the actual situation we had happen in our office where somebody lent money from their IRA account to a third party, and the third party's collateral that they offered for the loan was a piece of artwork. They described the artwork in the note, exactly what it was, where it was held, etc. The issue that we brought up for the client was, what are you going to do if this person stops paying your IRA back? Because your IRA would be prohibited from actually repossessing or taking possession of that asset and kind of calling the note due and taking that asset, because your IRA cannot hold a collectible. So we made the client well aware that this was a possibility, and that their only solution, if the individual stopped paying on the note, would be for their IRA to assign or to sell that note to some other party who could repossess and take back the collectible. So there was certainly an issue there of the client realizing, if my IRA doesn't get paid back, what is going to be my next step to recoup part of my investment? So again, that's just something to really think about when making that type of loan. And again, we did process that investment. We had the client sign off on a waiver, but again, we made that very apparent to them. These are the issues that you might have if your borrower does default. As far as why people invest in private loans, I think some of the reasons we've heard from people clients over the year and other individuals I've talked to, one, they like the control of being able to really act as a bank and setting a rate at which their IRA is going to grow. You are lending money to a third party. They want to borrow money from you. You're going to tell them exactly what rate they're going to pay. And by doing so, if the person's paying consistently, you know about what rate your IRA is growing at. So if you can lend money at, say, 8, 9, 10, maybe even 12%, depending on who you're working with, and you know that that loan is going to get paid off, and you're going to get consistent payments, you know that that's the rate you're getting. You're not in a CD at a bank account getting 1%. You're not riding the stock market at the ups and downs there. And I think that's one of the attractive things about private lending that people see within their retirement account. Also, it can be a very low maintenance asset. A lot of our clients, instead of investing in notes, they might invest in actual real estate, which requires you to make sure your tenant's paying a mortgage each month, make sure that all the expenses, the maintenance are getting paid from out of the IRA, making sure there is maintenance going on within that property. So it can be a little bit more involved being a landlord than simply being a lender. So for some individuals, they like the control of being the landlord, but others decide, hey, it's better if I just simply lend the money. I just need to make sure I get paid once per month and the money's coming back into my account. And similarly, the fact that owning a private loan can be less liability than owning real estate directly. If somebody slips and falls on your property, they're going to sue you as the homeowner. They're not going to sue the bank that is actually holding your mortgage. So similarly with an IRA account, if an IRA owns real estate and someone slips and falls, the IRA wants to make sure, you'd want to make sure that your IRA is protected and you have insurance to cover that potential claim. Probably don't need the same protections if your IRA is simply investing in a private loan, if your IRA is just a mortgage holder. Now, when you are looking to lend money from your IRA account, again, the neat thing, at least in my estimation, the neat thing about doing a private loan is that you get to establish the note terms. If someone's coming to borrow money from you or borrow money from your IRA, you're going to make the determinations of how much you're willing to lend, the amount that's going to be borrowed, what interest rate are you going to charge, what's the length of term, do you want to be paid back in, within 10, 15 years? Do you want to be paid back within 6 months? Is the loan amortized or is it interest only? Are there any equity participation? Again, we'll go through an example of that a little bit later today, but having somebody who is rehabbing a house, for instance, and your IRA lending them money, having them split a portion of the profits with you back into the IRA account. And again, all these terms are really up to you as the IRA owner as to what you would accept. The only caveats we usually, at least the red flags that come up for us, usually revolve around the interest rate. If you're charging a stated interest rate of above 18%, a lot of states consider that to be usurious and against the law to charge that high of an interest rate. Also, if your interest rate is too low, if you're charging, say, 1%, 30-year mortgage without anything else going on, that doesn't make sense. I mean, your borrower would have had to pay at least 4 or 5% maybe to get that type of loan through a third party. So to expect that your IRA charges a similar amount of interest is there as well. I want to kick off, just go into some case studies, really illustrate a few things more about the types of loans we see, and also really about how that process works. So what does it take to actually get an IRA established and make this type of loan within the account? Now, the first example, we have Paul. He has an old 401k from a previous employer, looking to get more returns. Maybe he doesn't have the investments options at the current custodian, or maybe the investments just aren't panning out and he wants to do a little bit something different. So after research, he realized he could loan money from his IRA. Maybe he's using a private mortgage lender to help him hit up with people, or maybe he's just going out to networking meetings. But he realizes by doing the private loans and lending money from his IRA, he's going to be then in control of what those terms are going to be, what that loan is going to be. So he decides to lend the money out, and he is working with a mortgage broker to lend his $120,000 out to the borrower. Now, working with a borrower, he finds someone who's willing to do an 8% loan. It's interest only for 5 years, and it's got a first mortgage. So he's probably working with a borrower who maybe has some credit issues. Maybe they went through a foreclosure, so they're going to have to pay a little bit higher interest rate. But by doing this, by getting this type of loan, he's essentially getting a CD, but with a much better rate. Even if this was an amortized loan, it was not interest only, it didn't have a balloon, he's still earning probably more than he'd be getting in a CD at a bank. And he's got security for the loan, and that the mortgage, the note, is secured by a piece of real estate. And obviously, Paul would want to do his due diligence to make sure that the property that is collateral is adequate, and that certainly would be part of his due diligence process of evaluating the property, evaluating his borrower. Possibly the mortgage broker might be doing that a lot for him too. But these are the terms that he establishes with the borrower. And the process involved, certainly Paul would open up and fund his account. It's a matter of Paul filling out our paperwork to get an IRA established. If he's rolling over a 401k, he would contact the administrator of that old 401k account and tell them he would like to do a direct rollover to an IRA and give them our information and the account number he's established with us to actually get that process going as well. Again, Paul's responsibility is to find the loan and to analyze the terms. We are not going to look at the note and the mortgage and decide if the property that he's lending on is sufficient collateral, or if his borrower is a good, has good credit history or whatnot. That is all going to be Paul's dealings. Again, we're not going to really too much look at the terms of the loan as well. If he's doing 8% with a 5-year balloon, that's fine. If he was doing 5% with a 30-year AM, that's fine. So it's really going to be up to Paul to decide what terms he's going to accept within that loan. He's going to make the offer to loan the funds, and he's going to submit a form to us called a purchase authorization form. Here is the document basically telling us at Advanta what it is that he's looking at investing in. So he's going to tell us, I'm making an 8% loan of $120,000, and it's secured by this particular piece of real estate. He's also going to let us know who's handling the title, who's handling the closing for this particular purchase. Our job then at Advanta is to contact the administrator, the title company, the attorney handling that closing, make sure that the wording appears properly on the note and mortgage to show his IRA as the lender. So instead of the borrower signing a note promising to pay to Wells Fargo or promising to pay to Bank of America, it's going to instead that the borrower promises to pay to Advanta IRA for benefit of Paul's IRA account. So the legal wording is right on there that his IRA is the owner of this particular mortgage. And that's very important to preserve the tax status of the IRA account. If the IRS were ever look into this transaction, they're going to see clearly that his IRA owns the note, and that any interest payments, any gains from this particular investment are going to come back into the IRA tax deferred. Once the documents are prepared correctly and the wording is correct, we will send the documents back to Paul, have Paul initial off on each page that he has read and approved the documents. It's very important to us that the client has reviewed, has read the documents, and again has indicated their approval that these documents are acceptable to him for us to go ahead and fund the note. And once we have that approval, we certainly fund the note. And then going forward, those monthly interest payments simply come back to his account. So his borrower, instead of sending their check to a Bank of America or to Wells Fargo, is going to make a check payable again to Advanta IRA for benefit of Paul's IRA account, mail the check to our office, we will deposit into his account, and then Paul can track his statements, or his payments, I should say, using online statements. He can log on at any time to see the history of payments within the account. He can also, our system will send him an automatic email. Anytime funds are received into the account, our system will send an automatic email to him letting him know that payments have come in. So if he doesn't see a payment, say by the 5th of the month, he'll know that his borrower hasn't made the payment and that he needs to follow up with them to make sure payments are made. That's one thing we don't do as the administrator of the account is we are not a loan servicer to the extent we are not going to pursue individuals who haven't made payments. That onus is on the client, the IRA owner, to make sure their borrower is making regular payments. When this mortgage when that property sells and the mortgage is paid off, basically the proceeds are going to come back into the IRA without any tax consequence. Likewise, the interest payments that he has received over the time that he's had the loan all have come back in to the IRA, no tax consequence to Paul whatsoever. Because again, this is income to his IRA. It is not taxable to him. Our next example, we have Andrea, who's looking at investing along with a fellow real estate investor who's doing fixes flips. So they're actually someone who's buying property, getting it fixed up, trying to get it back on the market in a rehab scenario. She has money in an IRA. She's got, say, a traditional IRA with a Morgan Stanley or a Charles Schwab, but looking at getting better returns. She sees and she belongs to a real estate investment club. She knows people are making money, and she knows that potentially she could earn much better returns within her IRA by making that investment as opposed to sticking it out in the mutual funds. During her time at the real estate club, she meets Steve, and Steve is somebody who's out there fixing and flipping properties. Steve is always looking for more money to acquire the next property. He prefers working with a private individual as opposed to trying to get institutional financing through a bank. And so they talk, Steve and Andrea talk about what his next project is, what he needs to complete the deal. And again, it's very important that Andrea perform the due diligence on Steve and on the property he's looking to buy. And it's not our job at Advanta. We're not going to run a credit check on Steve. We are not going to ask for comps on the piece of real estate that he's looking at buying to make sure that the loan that she's going to make is going to cover the acquisition, the rehab costs, whatever they've decided between them. So it's, again, very important Andrea does that step of the process and evaluates, again, Steve and the actual property. She does that. She's satisfied and offers to lend him $100,000 to buy and fix the property. So she's going to get a first mortgage on that particular real estate. Now, when Andrea and Steve were having a discussion, though, she found out, and talking to others as well, that Steve usually does quite well on his flips. He makes a good amount of money for each flip property that he does. So instead of getting an interest rate, Andrea asked Steve instead, well, how about instead of charging you maybe the usual 10 or 12% you would pay for an institutional or a hard money loan to acquire and flip this property, how about instead I just charge you 5%? But what I want in return is that you're going to give me a portion of the profits from the actual sale. So when Steve gets the property successfully flipped and sold, her IRA would participate in some of the profits. That's why we call this really an equity participation or a joint venturing deal. They're kind of working together and are going to share in the profits. And Steve is agreeable because he can pay a lower interest rate, and he doesn't mind sharing a part of the profits if he has the, obviously what profits he has for the ease of doing this deal through an IRA account. And again, Andrea makes sure this property is secured with a first mortgage, so it's a low monthly payment for Steve, but it's also, Andrea has a security that if Steve defaults on the loan, she can at least take back the particular property. It would be up to Andrea to make sure that her attorney or whomever prepares the note and mortgage correctly and with whatever terms they decided on as far as the loan, but also the legalese that goes along in those documents. And again, she's going to review and approve all the documents for us, the note, the mortgage, any lender's title commitment, the HUD statement, and she's also going to let us know with that purchase authorization form the terms of the note and who she's working with, so we can help and assist her IRA in this particular closing process. So once she's approved the documents, we've wired the money to the title company. Steve's now rehabbing the house, purchasing the house, getting it rehabbed, etc. When the loan goes to pay off, Andrea will work with us and work and see what payments have been made, look and see what the profits are going to be on a sale, and kind of develop what that payoff amount would be, and forwards that to the title company that's handling the closing. So when he's actually selling the property, her IRA is going to have to satisfy that first mortgage and in exchange for the money that she gets in. Now, as far as her account, within a 6-month period of time, she earned a little bit of interest, about $2,500 or so, on her money during that 6-month time. But the big key to her investment return here was the amount of profit she made. Steve did a good job rehabbing the house, obviously resulting in more funds back into her IRA account. If she'd instead decided to charge, say, 12% interest and just a flat hard money loan, her return here would be $6,000. I mean, 6% basically over that 6-month period of time, so much less. Now, again, the part of this deal is obviously that Steve made profits. If he had broke even on the property, she would have earned only $2,500 on her particular investment. So just something to consider when you're doing this type of investment, this kind of structure. We have seen people do a 0% interest rate and have it, though, be a equity split of half and be 50% profits to the IRA, 50% to the buyer. So it's really, again, up to the client in this situation to make those determinations on how they wanted to structure the investment. Maybe she would have felt more comfortable doing just 12%, knowing that in 6 months she would earn $6,000 back in her IRA and not have to worry about necessarily how much profit Steve was making on the deal. Now, if you look at the deal from Steve's perspective, he had an original loan. He sold the house. Even after paying her loan back, any points, any interest, etc., he still earned $17,500 on the deal. So he still did pretty well in basically flipping this house and making a good deal of money. Now, what's not in this example, and certainly could be included, just for the sake of easy numbers, Steve didn't put anything down. Maybe it was 0% down and got the straight loan from her IRA account. Certainly, Andrea could have asked him to kick in additional funds up front to make sure that he had some skin in the game. That would be a decision, again, for Andrea to make in making this particular loan. Now, I did have a question pop up on the screen. And again, if you are listening and have a question, please type it into the chat box. It says, how much longer does it take for our process versus typical financing? Well, I'm not always sure how long typical financing would take. I guess maybe the general rule of thumb is maybe at least 20 to 30 days, if not more. If a client has money in their IRA account, so they've already opened their account, they've completed our paperwork to get an account opened, they've transferred money in from another IRA firm, so you have a cash in the account. The length of time for us to close really depends on how long it takes the title company to draw up the documents and how long it takes for you as the IRA owner to approve the documents. So it could happen in as little as 2 or 3 days if the account is set up and if there's cash already there. If you don't have the account set up and you're going to lend money to a private individual, usually the process is going to be somewhere around the 2 to 3 weeks to get that process going. It takes, once we get the application from you to open the IRA account, we get the account set up, get the money transferred. Usually that's within that 2 to 3 week period. It really depends on how long it takes your other custodian to send us the money before we can then close. So if you have the accounts already here with the funds, it's a matter of a few days. If you need to get an account set up, you may be looking at a few weeks. Another question came up. I'll go ahead and just address this one. It says, what fees do we charge? For a private loan, we charge a $95 transaction fee. So that process of going through the loan, working with the title company, the attorney, making sure that the loan documents are properly vested for the IRA account, it's a $95 charge. And then our annual fee, we charge $295 a year to record keep. That's for each asset is in the account. So in this case, for Andrea, she would have paid us $95 and $295 to hold that asset within the account. We also have wire fees as well. If you're doing a lot of loans and doing a lot of different transactions, there's other ways to lessen some of those fees. We have a different annual fee structure. Instead of charging $295 a year, we may charge a fee based on the overall value of the account. And I've also seen people use LLCs and use private trusts to help limit how much fees would be charged as well. So just another thing to consider. I'd encourage you just to give me a call after the webinar, and I'll be happy to kind of run over any scenarios that you might have in mind and what our fees might look like. Just some other things to consider if you're using non-real estate as collateral. So in the previous examples, there was collateral was a piece of real estate. If you have to foreclose on that type of loan, there's a process involved. There's a foreclosure process for you to get back that property. If you have that note secured by something like life insurance or collectibles we talked about earlier, it can make that collection difficult. And actually trying to doesn't make it prohibited necessarily, but it's going to make it difficult for you to get your money back if that person defaults. If you have a note, if you're lending money to maybe a company and they secure your note with stock in the company, so maybe instead of paying you back, they can opt to simply issue you stock, you need to make sure you understand how that entity is taxed. If you are lending money to an S corporation, your IRA would not be permitted. Under S corporation rules, your IRA is not permitted to be a shareholder. So your IRA could not exercise its rights for stock in that circumstance. Or if you're lending money to a partnership. So you've lent money to an entity that is being taxed as a partnership, and your IRA ends up becoming a partner, you could subject your IRA to what's called unrelated business income tax. If your IRA is invested in a business and is getting back a portion of profits each month as opposed to a dividend, for instance from a C Corp, you could subject your IRA to a tax. If you're going to be investing in a note secured by stock in a company, make sure you look into how that business is taxed in case you end up owning that stock within your IRA account or having the potential to own the stock in your IRA account. Lastly, if you're not using real estate as collateral, you need to figure out what you're going to use as a security agreement, and also how are you going to put other people on notice, or where are you going to record the fact that you have a lien on that particular asset. Again, with mortgage loans, with real estate mortgage loans, if you lend money to someone and you record a mortgage, that's a flag on title. That person cannot sell that property to a bona fide seller without satisfying your notes. So you'll know that everybody is on notice that you have a lien against that property. But if you're using other types of assets, how are you going to put people on notice that, say, for instance, that your IRA has a lien against that piece of artwork, or your IRA has a lien against these other assets that don't have titles? People have used UCC filings and have done other things as well. We're not going to tell you what you should do or what you shouldn't do, but you would need to think about that. You wouldn't want to have, quote, a secured loan, but nobody has any idea other than you and the borrower that you have that security interest. You need to find a way to make sure that you put other people on notice in case an individual wants to sell that asset. You want to make sure that you get paid back. In our next example, we'll talk about an individual simply doing an unsecured loan. In this case, Tom has money in his SEP IRA. His buddy has a business, looking to get a business going, needs some startup capital on a short-term basis. I just need to borrow the money for a year or so, and I'll pay you back. Tom decides to do this loan, and maybe his buddy does not have any collateral that he can put up or wants to put up, and Tom is fine with that. Again, Tom realizes what's going on. He trusts his friend implicitly. Then again, it's going to be something completely up to Tom to make that decision. It may not be a loan that you or I would do, as far as saying I would loan $50,000 on an unsecured basis to a friend or anyone else. In this case, Tom made that decision to do so. Simply did a $50,000 loan at 10% at the end of the year. His friend's going to pay him back the interest and the principal all at one time. What this example really is illustrating, number one, again, you can make loans that don't have security, and that's up to you and your risk of how much you're willing to take that risk. Also, again, the terms can be various. In this case, instead of getting regular monthly payments, Tom just told his friend, hey, at the end of the year, we'll just arrange for you to make one lump sum payment back to me. Maybe his friend has an asset that he'd be able to pledge at that time to come up with the cash and pay off Tom. Now, just some things to consider when doing an unsecured note. Because there is no title company involved, okay, when you're doing an unsecured loan, we simply use a promissory note that's signed, and we send the cash directly to your borrower. There's no title company involved. We must have possession of the original note before we will fund. Now, if we are funding a mortgage loan through a title company or an attorney, that person or that party is entrusted with getting the documents signed before they release the funds. That's their job. That's what they get paid to do. We are okay with that happening. But in the case of an unsecured note, the person simply signs a note, and that's it, and they send the note to us. We must have that note signed and in our possession before we will release the funds. Also, the rates tend to be a little higher with unsecured notes. Obviously, they're not secure. There's no security, riskier. Just like credit cards are a form of unsecured notes, and we all know the rates there tend to be a little bit higher as well. And again, just make sure you know your borrower. If you invest in a private loan, a private unsecured note, and that person defaults, you're going to be at the bottom of the list if that person ever declares bankruptcy. So make sure you know who it is that you're dealing with. Next case study involves an individual. This is based on a client. One of our clients does a lot of seller financing. He actually acquires real estate with his IRA account and then turns around and sells that property and carries back the loan on that particular asset. So it's kind of two steps to this process. In this case, Jim has the money in a traditional IRA. So he's opened the accounting and transferred funds to us, has the money in the IRA, wants to buy foreclosures, get them fixed up. He buys these properties at auctions, gets them fixed up, and instead of renting them, or instead of flipping them necessarily to somebody else, he actually is willing to sell them to a third party and an end buyer who will then in turn pay him basically installments in the form of a seller finance mortgage. So the steps involved in this process, again, here's his terms first on the mortgage loan. It's $70,000 loan, 8% interest, amortized over 15 years, a low monthly payment, again, does get that first mortgage on the property. Now, going through the transaction, Jim will be working with us initially to buy this property through foreclosure. She's going to tell us what the property is that he's buying, what the purchase price is, who he's buying it from, what the county is that he's doing the foreclosure process. So we will assist in that initially, making sure that the deed to the property is made out to his IRA, Make sure he's approved that. Make sure he approves any HUD statement or settlement statement. When he's getting the property fixed up, we will also process those checks for repairs. If your IRA owns real estate, your IRA must pay for any expense associated with that property. So all of the fix-up work that needs to be done, Jim's IRA would need to pay that, and that's the job that we do at Advanta. He sends us the bills, we get a check cut to pay that. Then going forward, when he puts the property back on market, we will go kind of on the seller side. We will sign the document, sign the contract selling the property from his IRA to that third party. So he will approve all those sale documents, and he's also going to approve all the new mortgage documents. So again, his IRA is basically taking a property, selling it to somebody else, and allowing that person and acting as the private lender to finance the balance of that purchase. So he gets a down payment of $10,000 from the new buyer to get basically got back his repair costs, gets that $10,000 put back into the IRA, and his IRA holds the balance of the purchase price in the form of a seller finance loan. So again, he's going to review and approve for us also then the note and the mortgage document that the borrower is going to sign, promising to pay back to his IRA account. So at the end of the day, Jim bought a piece of real estate, but he ends up holding a private mortgage within his IRA based on that real estate. So he gets monthly cash flow back to the IRA, but doesn't have to pay any expenses. He simply has the mortgage loan, and essentially he got his note at a discount. He bought the property for $40,000, and he ends up at the end of the day holding a $70,000 mortgage note within his IRA account. Certainly he could have sold the property outright if the person had cash, simply paid him $80,000 for cash, or instead in this route, he able to take that $70,000 profit that he would have, $70,000 proceeds he would have had, and just turn it into an amortized loan over 15 years. The previous four examples really discuss, again, more the IRA acting as the lender in a situation to a third-party borrower. And this is the last case study we have in the webinar today. It's going to focus on the IRA itself actually borrowing the funds. And the circumstances, not too often that we see this done, but it is possible to do with an IRA account, having the IRA borrow funds in the form of a non-recourse loan. So in this case, we have Mike, who has money in a 401k account, wants to roll it over and to buy some real estate. Now, the issue Mike has is he doesn't have enough in the account to simply pay cash for the property. The property he wants to buy is $100,000, but it's basically turnkey. It doesn't need a lot of repairs, just maybe a little bit of paint, a little bit of carpet to get the property fixed up and getting it rented. So Mike has a situation where he doesn't have enough money in the IRA. Maybe he doesn't have anybody else that he wants to partner up with to buy this particular piece of real estate. So he decides instead, I'll use some money from my IRA as a down payment, and then I'll finance the rest of the purchase using a non-recourse loan. Now, the non-recourse loan is a very important part to understand in this scenario. The way the IRS rules are written, you cannot use your IRA as a down payment for a personal loan, and you personally cannot guarantee a loan to your IRA account. The IRS rules prohibit that. So if Mike is going to borrow funds from a lender, the loan has to be from the lender to his IRA account, and he cannot personally guarantee that loan. That's something, again, it's not very often that we see done, but it is possible. Now, the lenders that do these types of loans usually want anywhere between 30 and 40 or maybe even 50% down with some cash in reserve, because the lenders understand, the ones that do these types of loans, what a non-recourse loan is that if Mike's IRA stops making payments on the property, the lender's only option will be to foreclose on the property and take back the property from Mike's IRA account. So it's a riskier loan for the lender to do because they don't have any other way. They can't go after Mike. They can't go after his IRA for any other cash. They simply would have to take the property back and sell it. Also, if you do loans within your IRA account, if you're non-recourse loans, I should say, if your IRA borrows money to use to buy a piece of real estate, you subject the IRA to what's called unrelated debt financed income tax, or UDFI tax. It's very small window of circumstances that your IRA might have to pay a tax, but this is one of them. So in this case, if Mike has leveraged 50% of the purchase price, that means 50% of the income he receives from this mortgage piece of real estate will be subject to the UDFI tax. So again, it's only the income that's for the percentage of financing that is subject to the tax. And as his IRA pays the loan down, so as he makes payments over the years on that loan, and becomes the fact that the loan is only 20% of the overall value of the house, then only 20% of payments would even be subject to this tax. Now, if your IRA does have to pay this tax or is subject to the tax, the IRA would file Form 990T, IRS Form 990T, and your IRA could then deduct a percentage of expenses and depreciation to offset how much tax would actually apply. And if you have less than $1,000 of income subject to UDFI, you don't even have to file the 990T tax return. So again, the important thing to remember, though, is if your IRA is leveraging real estate, you might have this tax to pay, UDFI tax. And also the important thing about the tax is to remember this is a tax that your IRA pays. This is not a tax that you personally pay. So the 990T does not show up anywhere on your personal tax return. Now, as far as the loans, not surprisingly, the interest rates are a little bit higher, usually about a point or two higher than what they would be for conventional mortgage loans. But we had somebody do one recently with a 7% fixed rate. Actually, I think it might even been lower than that, over 20 years. So his IRA, Mike's IRA in this instance, has to make a monthly payment of about a little under $400 a month to the lender. Now, the lenders who lend on non-recourse loans, they also want to see that the property is an income-producing property, because they know the IRA is going to have to make that monthly payment each month. They won't lend on raw land, for instance. Now, just a quick case study of how the UDFI tax works. This is an extremely simplified version of the tax. It does not take into account at all depreciations and deductions. If we figure Mike can get $900 a month net from this property, the $900 is going to be subject to UDFI. Only half of it, so that he had total rents are a little under 11 grand, but only half of that, $5,400, is going to even be subject to UDFI. The other $5,400 goes right back into his IRA without tax consequence. Now, if we assume the top tax rate for UDFI tax, which is 39%, he's going to pay $2,100, or his IRA, I should say, will pay $2,100 in taxes, ultimately leaving him with a net income minus the taxes of $8,600. He had $5,400 not subject to the tax, and another $3,600 or $3,200, I should say, that came even after he paid the tax. So his IRA is returning a little under $9,000 on a $50,000 investment. So this might be a situation where leveraging could certainly make sense for Mike. If he can keep getting those types of returns in the account, he's going to pretty good return on his money for that $50,000. When you look to do leverage within an IRA, this is definitely a situation where you need to get a CPA involved so that you can run the numbers and see ultimately what your returns may be on that particular investment, and does it make sense to finance, or should you just look for a different property? Well, that concludes today's webinar. If anyone, again, has any questions, I'd be happy to answer them now if you can get them typed into the chat box, or simply call me or email me at the information on this last slide. I'll be happy to go over anything that we talked about today in more detail with you, or answer any additional questions, or if there are things that maybe we did not cover. Your questions may be more investing in real estate or investing in a private placement and how that process works. I'd be more than happy to talk with you there. So certainly give me a call or send me an email, and also visit our website at advantaira.com. Other upcoming seminars, other upcoming webinars are always listed on our site. They are always free of charge as well. A question did come up: can an LLC invest in another LLC? And the answer is certainly yes, depending on what that other LLC is invested in. So if my IRA has invested into, say, a single member LLC, my IRA owns an LLC, and I want to have my IRA LLC invest into another one, that certainly is possible. Although if the second LLC was one that was owned by me personally or owned by disqualified persons, that would make it a prohibited transaction. So the answer to your question is yes, in theory. It just depends on who all the parties are that are involved, to make sure that your IRA or your IRA LLC is not investing with or transacting with anybody who'd be considered disqualified. So again, I thank everybody very much for attending today in the webinar. Please visit our website to find the kind of upcoming webinars, upcoming seminars. We do vary the topics from time to time, and hope and trust that you'd find those well worth your time if you attend. So again, thank you very much, and I look forward to talking with you.